Good morning, and thank you for joining us for our Q4 market update. My name is Cole Pearson. I'm the Vice President of Investment Solutions here at OneAscent, and will be your host this morning. As we move into our agenda, we've got a lot of great information we're excited to share with you. In just a moment, we'll introduce our manager spotlight for today. I'm glad to be joined by Brian Liu, who is a manager on the Alpha-Centric Income Opportunities Fund, which is included in our models and various portfolios, as well as Nathan Willis, our Director of Portfolio Strategy here at OneAscent, who will share an update from our investment committee and outlook. If you have questions throughout the call, we'd love to answer those in the appropriate order. You can submit those by email to info@oneascent.com. And if we're not able to get to your questions on the call, we'll certainly follow up after the fact. If this is your first time joining us for one of these calls, we do hold them every quarter on the third Tuesday of the quarter at 10 a.m. Central. So we'd love for you to mark your calendars for the next few in January 18th, and April 19th. Every quarter, we hold these types of calls. Well, as we get started, the market has, you may have seen volatility recently in these past few weeks. It's always helpful to harken back to the why, the basics. And so that starts with our investment philosophy. And so just as a reminder, not only to ourselves, but to you guys on the call as well, I want to remind you what that investment philosophy is. The first part of it is values-based. We believe aligning your investments with your personal values is a wise approach to investing. So that flows through everything that we do here at OneAscent. Secondly is a long-term focus. We maintain a long-term focus also in investment analysis, but also in the management of our business. And so that's an important kind of mindset to take, especially as we experience shorter term volatility. And lastly is global diversification. This is not a new principle. This goes back to even biblical wisdom, but globally diversified. We invest across multiple markets and asset classes to mitigate risk and enhance potential long-term return. So that's the philosophy that undergirds everything that we do here at OneAscent. And what that looks like in practice is a series of risk-based, globally diversified portfolios, ranging from a preservation or a conservative type approach all the way to an aggressive or more aggressive or equity-oriented approach. And so it's always helpful to kind of know who's speaking and why. And one of the things that we want to make sure that you're clear of if you're a client or an investor in our solutions is understanding how our team works for you. If you are an investor, you probably work with a financial advisor, and that's your primary point of connection or relationship. Your advisor sits there at the top and makes sure that your portfolio is right for you. But we also have the OneAscent Investment Committee that we bring to bear. You can see those members there who do a lot of work meeting with folks like Brian and others and doing the work to make sure that our allocations are appropriate. You'll hear about that in just a moment. And then we also have great portfolio managers. We work with lots of different firms. Some of those names you may recognize. Their household names are world-class in their categories. And so today we're excited to be joined by Brian Liu with Alpha-Centric. You can see their logo there in the bottom right to talk about something that's going on in the fixed income markets, the bond markets. And so with that, Brian, I'll transition to you and introduce Brian Liu. He's a Managing Director and Chief Investment Officer at Garrison, which is one of the firms that manages the Alpha-Centric Income Opportunities Fund. So Brian, thank you for joining us this morning. We appreciate our partnership, and I'll turn it over to you.
Thanks so much, Cole. Thanks for having me, and really happy to be on this morning. I can't stand that picture of myself, but appreciate having the bio and the information in the background. I think it's a really interesting time that we're looking at now in the fixed income markets because we've been so stuck on low rates for the last, going on 10 years now, right? I think that after the great financial crisis, and maybe it's even more like 13 years now, in fact, but after the great financial crisis, everyone thought that it'd be a fast move up to see rates higher, get back from those early days where they kind of rescued the market, so to speak, and then we would start seeing inflation and rates and everything just really roaring back, and we still haven't seen that, right? It's just been 13 years of kind of a continual, I don't want to say a slog because there's certainly been a recovery in there, but I mean, I think there's no question that we've had this era of low rates, and so the big questions these days are, how is this inflation that we're starting to see, how is that going to interact with Fed tapering and with an eventual rate tightening, or will there be, and all those things. And so I think the easiest way to start off would just be with something like inflation, right? It certainly doesn't look transitory at this point. There's huge bottlenecks, right, that are appearing everywhere. And, coming out of the end of last year and seeing the vaccine start to roll out and all those things, you would kind of thought that, this COVID would be part of our past and we could get back to, quote, normalcy, or things going back to the way they were, people going back to the jobs they had, people wanting to work again because, government programs were going to start running out and all those things. But instead, it's been anything but, right? Anything but a clean reopening. I mean, whether it's questions on the vaccine rollout, or how effective it is, or why we still have masks on, and why we need a booster, and all those things, those things have left things in more of a question mark state, and so things aren't fully opened up yet. We just had a jobs report a week and a half ago, and 200,000 jobs were created, and that was way worse than the 500,000 expected. And yet you still have, administration claiming that there's at 4.8%, things are looking good. They're showing progress and stuff like that. It's an interesting time where people have realized that Fed or government programs, which can help, they were kind of rolled out to help get them through the pandemic. Whether it was, higher unemployment insurance, or, those kind of supplemental payments, those things maybe were intended as a way to get people through. But I think, in a lot of ways, folks thought, this isn't such a bad thing, right? And so you could look at that if, we're even going to pivot a little bit more to some broader issues of kind of social justice and stuff like that. Maybe that's something they felt like they deserved, right? That taxing the rich more, or just borrowing more, or printing money, or MMT, anything like these, maybe those things were going to be a good part of the solution for these government programs. And as a result, or similar kind of in conjunction with that, 4 million people left their jobs, right? So now we have this weird situation where people are deciding, well, I didn't really like my job prior. It wasn't paying me all that well. Here, I've taken a pause, maybe been able to supplement that with some of these government payments or programs and stuff. And that's made me decide, well, I actually want to go and change and learn coding, or learn some other skill and do that instead, right? And so it's kind of this transition period for labor. And as a result, you've got huge shortages, right? And so, for example, out here in California, we've got 100 container ships waiting out at the port, right? That's the latest record, right? They just broke the record from last month, which was 97 ships. Each of those ships takes about 2 or 3 days per ship to unload, right? So you've heard all kinds of stories, probably experienced it yourself, about shortages and delays and all those kind of things. And I think the president came out and said that he cut a deal for keeping that port open 24/7, and it's debatable how much he really did as part of that deal. And in some ways it's debatable how much that extra time is going to help, right? You're talking about 2 to 3 days per ship. Let's say it cuts it down to 1 or 2 days per ship, right? That's still going to be, with 100 ships, that's still going to be something like a 3 to 4 to 6 month backup, depending on how all those things go. And that's, I think that the numbers that they estimate are it's something like 40% of the goods coming through are represented in this 100 ship backup out there. And so you have huge shortages in labor that need to get these products off the ships to unload. You've got a shortage in the drivers who then get those, after those products are unloaded, they have to drive them out to the different points of distribution in the U.S. You've got people saying that, well, if things, these strikes and stuff, if I'm so valuable, right, that you need me to go out here, maybe you should be paying me a little more. You got teachers unions. You've got frontline workers and other people who said, like, I had to work during the pandemic. I took all these risks. You need to pay me more. And, in a lot of ways, look, we signed up for capitalism, right? We like the fact that, kind of supply and demand offset each other, and demand dictates wages and dictates prices, all those things. And so as you start getting labor costs increasing pretty dramatically, those things start getting passed along, right? All along the supply chain, right? Whether it's restaurants and their ingredients now cost more, or they have to pay the wait staff more, or anything like that, we are starting to see those things really make their way into the market. And that's obviously causing higher inflation, and it certainly doesn't look like those things are going to back up anytime soon. right? If I even look at these container example I gave, if it's kind of 4 to 6 months, and that's when things could finally loosen up, or that bottleneck finally loosens up, and demand, or supply goes higher, right? Because things are finally loosened up, and that makes costs go down a little bit. That's still kind of a long time from now. That would not exactly be transitory, right? And I think that what we're learning out of all this is that going back to normal isn't really, it's kind of a redefinition of normal, right? And people are kind of taking advantage of that. I think that many of the government policies are questionable, right? I think that, and that's from my own personal point of view, I think that many of them are long overdue, right, from others' point of view. And so, really it kind of depends on, I guess, maybe a lot of his political stance. I think some of that certainly moves into your economic consequences sort of issue, right, where people say, like, well, if we're just going to keep borrowing, that's going to certainly affect things like rates, which kind of affects inflation and all those things. And so now when we're talking about passing on labor costs, we're talking about high demand but supply being low or lagging because of these different bottlenecks and stuff. That to me sounds kind of like a semblance of stagflation that we started seeing, right? Because you got an economy that's moving along, but it's still kind of held up by the supply side, right? And yet you've got things going up in price, right? And so you've got, maybe it's not the classic stagflation where you just have low productivity or low output, because here it's just more of a kind of a delay in the supply, and there's a huge demand component to that as well. Okay, so we're at sort of loggerheads in all these things, depending on again on your political viewpoint. You might say that some of those things are bad or good, or kind of a combination of both. I think that kind of underlying a lot of this is this whole idea that during the pandemic, many households were hit much harder than others were. And, with the stock market that came roaring back, and with financial assets doing really well, and, low rates really propping up a lot of those sort of assets that are more in line with what people who have 401ks and people who have financial assets and financial exposure and financial things, those things, it caused more of this kind of, whether you want to call it outrage or false outrage or just kind of political theater, right, of a lot of people saying that, once again, we're only bailing out the wealthy, and the lower incomes and stuff are kind of left behind. There's this real undertone of all of that that I think is gaining more and more, not popularity, but just more and more notice. I think that this, the more progressive arm of the different parties and part of the government is getting louder and louder. And so, there's a lot of balancing that everyone needs to do out there, economic realities and low rates and all that stuff versus, what's going on in this kind of social aspects behind it. And so that's a little bit of a diversion, but you can see that along with all the actual things that we're experiencing with stagflation or this semblance of stagflation and supply bottlenecks and all that stuff, it is all leading to, a big kind of interesting next several months that we'll see as things start to unfold. Okay, and so I think that this inflation is not transitory in the sense that it's just kind of going to suddenly go away. I think we're going to look at that for several months to come, right? And so if inflation and prices higher has been a target of the Fed, and maybe they overshot it this time, are they really going to taper, right? Or is it really time to taper now that they said, once we get things stable or get this 2% inflation, we're going to start to taper? They're buying $120 billion of a combination of treasuries and agency MBS per month. Right, that's $1.4 trillion per year, right? And that's a pretty sizable amount. Are they really ready to say that the economy is great on its own and we're ready to start tapering and remove ourselves? I think the Fed has long been convinced of their role in getting us out of the pandemic, and the tools that they have, the dry powder, as Powell called it, to get us out of this. I think that they're going to have to do at least a nominal bit of tapering, right? I think if they don't do any, then they just completely lose credibility, or maybe lose more credibility than they already have, right? We have become a government or an economy, right, that is convinced of the Fed's purpose in being able to save the markets and keep rates low, right? And that is a far cry from really saving the economy. I do think that certainly everyone on this call, as we talk about markets and investing and stuff like that, we like that. I think it helps us, and I think it's a good thing. But, can they really keep propping up the market? And, is it appropriate for the Fed to kind of keep propping up the market and keeping rates artificially low? I mean, that's kind of a separate question, maybe more of a philosophical question, but kind of in the immediate term, I think that they can only do something really nominal. Otherwise, they risk kind of pulling the plug or pulling the rug out from under the economy, right? I don't think we're on such firm footing yet, even with the high demand we're seeing. I don't think we're on such firm footing yet that we can really start to say that, we're ready to kind of keep plugging along on our own without some semblance of low rates, right? So maybe that moves our the 10-year range up from, it's been wrapped around kind of 1.5%, but maybe that moves it to a slightly higher range. We're about 1.6% right now, or this morning. Maybe it moves into more like 1.5 to 1.75, as opposed to the kind of 140 to 160 that we've seen for the last several months, right? And so, I think that might keep the range a little bit higher. I think the Fed will see some sort of, at least nominal tapering that they'll kind of try and experiment. And, if inflation hopefully kind of clears up and some of these supply bottlenecks do get worked out, Nathan and I were talking about this, a couple of days ago, just briefly. I know he's got some other kind of mitigating things that might be able to deal with some of this inflation aspect. So, hopefully some of those things will occur, but, it seems like in the meantime, we're going to, go sideways for a little bit on the 10-year and, again, probably see a nominal sort of tapering by the Fed. Maybe just a quick mention of how all that is going to affect our portfolio, right? Our portfolio is anchored around housing, right? We've got about 85% positions in these legacy RMBS securities. And those are securities which were issued kind of pre-Great Financial Crisis. And they obviously took a big dive down in the crisis, but certainly now any borrower who was going to default back then, they have shown that 15 years later they're still making their payments, still in that home. So we've got a great LTV on that home. That means that we've got great coverage for that borrower to continue making their payments and pay off their loan in full. We've got all those borrowers that are backing the bonds that we buy, and so those bonds that we bought at a huge discount now have a lot more credit worthiness, right? A better credit borrower underneath them. And then in addition, what we've seen during this pandemic time is that because rates have remained so dramatically low, that actually allowed a certain mechanism called excess spread to really help in the bonds that we buy, and that excess spread has built up credit enhancement for the securities, and that's allowed prices to not only kind of go up and recover from what happened last March, but also to give us better prospects for additional recoveries going forward, right? And those are kind of some different features of legacy RMBS, but we're up about 80% from our lows in March of last year. And, unfortunately, we had to go through those lows, but, it has been a pretty staunch recovery since then. We still think there's more to go. The fund is up about 13% this year versus the ag or, broader fixed income, which is down about 1.7%. And so, everything that I said about low rates and inflation, all that stuff, that fortunately has been a good thing for our portfolio, right? So low rates is good for housing, which is good for our portfolio. I do think it's just a much broader question. It'll be kind of interesting to see how we get out of a lot of what we've been dealing with the last going on 18 months now in this pandemic. And I'm kind of rambling on here, but that's kind of the backdrop that I'd say we're looking at in fixed income right now. Really appreciate the time, Cole and Nathan, and having me on, and I'll be on for any questions or any comments further.
Great, thank you, Brian, for those comments. To continue the theme of kind of connecting it back to the portfolio where you just finished and left off, would you mind kind of, for our audience, for whether there be advisors or clients on the call, you mentioned the legacy RMBS. Would you mind kind of explaining what that is versus other mortgage-backed securities agency? Could you kind of give a lay of the land, if you will, of how Alphacentric fits into that environment?
Sure. An agency mortgage-backed securities would be your traditional Fannie, Freddie, Ginnie Mae, right? These are securities that are backed by effectively Ginnie Mae, it's formally, but it's Fannie Mae and Freddie Mac, it's effectively the full faith and credit of the United States government, right? So you buy the security, it's backed by a bunch of mortgages, you receive payments of principal and interest, just like any, and then like any bond, right? You get some principal back and some interest per month, and that security eventually pays off at par, right? Those securities are backed by loans, which are conforming loans, right? They meet certain standards that the government requires, and that allows, by them purchasing those securities in the open market, right? Purchasing the loans in the open market and then producing these mortgage-backed securities, that helps keep interest rates low and it helps bolster the U.S. housing market. Okay, for us, we are in this group of non-agency mortgage-backed securities. So these loans are not government conforming. They are not backed by the full faith and credit of the government or anything like that. We just look at it more from a credit standpoint, that there's this big group of loans that back a security, and are we comfortable with the credit worthiness of those underlying borrowers? And these were issued just in huge amounts before the great financial crisis. In the early aughts or so, that's when we saw and heard all the stories about people buying 9 homes or over speculating on homes, and real estate was the hottest market. And really what it was that credit was easy, right? You could sign your name and attest to how much you made and you could get a loan, right? And that would let people, again, over speculate on housing or buying as many houses as you could. And then as rates started to go higher and people realized that their interest rate would float higher, right? Everyone started realizing that, they actually couldn't afford all these homes, and suddenly they couldn't flip them to the next highest bidder. And so as a very broad base, the great financial crisis was because of over speculating in the housing market, which was, kind of spread or propped up by this easy credit in the first place. Okay, so all these securities really took a dive. People started to default on these homes, and all these securities, which were backed by these loans, really tanked, right? And so as people default on their homes, the securities would get written down because there's defaults and there's losses that are in the deals. Well, as the housing market recovered, right, or stabilized, and then the economy recovered and housing went back, that suddenly meant that anybody who hadn't defaulted on their loan up to that point, they had actually survived this crisis. They had survived the great financial crisis, and they were still in that home. They probably still needed a place to live. Maybe they got help from friends and family. Maybe they got help from the financial institution to modify their loan or something like that. But we started taking more interest in these securities after the crisis because they had already kind of shaken out a lot of the defaulted borrowers, obviously. And so now what we felt was that we had a positively selected group of borrowers, and that they offered better prospects of continuing to make their payments going forward. And it's been about 10 years now since kind of that bottoming out of the market, of the housing market. And I think in conjunction with that, at least somewhat a bottoming out of these securities. And so when we rolled out this fund in 2015, right, we still liked this asset class and we liked the fundamental story of housing. We still think housing is a great underpinning of this economy, of quote unquote the American dream, right? It's kind of a historical 4% sort of asset class return. And so housing being something that gives you tax advantages, that gives you shelter for your family, all those things, we like housing as an asset. And that theme of housing backs all these securities that we're talking about, these legacy RMBS, which are, once again, they're not part of the agency mortgage-backed securities framework, right? They are not government guaranteed, but they are now kind of 10 to 15 years seasoned is what we call them, because they're legacy, right? They are from before the financial crisis. And so a lot of these borrowers went through the crisis already, and now they're still in their home many years later. And the bonds that we buy are backed by that type of borrower.
Thank you, Fred, and that color, Brian. We maybe have time for one more. We've been an investor in the fund for several years now, and it definitely has been, you mentioned performance for this year. It's been a bright spot across our portfolios. But last year, that wasn't the case, right? When COVID
sort
of first hit and the pandemic broke out, there was a little bit of sell-off in the fund. Would love to kind of hear your thoughts on what drove that, and what are the risks of that going forward? As clients look at their statements and they see, the alpha-centric name there, what should they be thinking about, or what should they be aware of going forward as it relates to what happened last year, perhaps?
Sure. And, before lest I be remiss at all, I thank you very much for your support in the fund and for staying with us and even kind of wanting to add more exposure, because we felt like it was a good opportunity once we got through that period in March last year, to really kind of redouble, so to speak, in a lot of the securities that had sold off. And so what happened last year was that, certainly the pandemic itself really caught everyone by surprise, right? And I think that in those early days, if you think about it, we just, nobody knew whether you walk outside and suddenly become a zombie. We didn't know the extent of what this COVID meant and what the pandemic meant and what it would do. And so people, in effect, the market just really went and tried to put as much money in the mattress as possible. Take it out of the stock market, take it out of the bond market, take it out of anything. And so there's a huge run on the market, right? Exacerbating some of that was that the people who hold some of these securities, these legacy RMBS, were levered players, right? So it was kind of these levered REITs. There were certainly some funds that had leverage built in, and when they had to start selling, right, it put pressure on everything. And we don't have leverage in this mutual fund, at least we're not a levered entity like a lot of those other vehicles were. But as we had withdrawals and we had just people wanting to redeem to, again, get money into the mattress as opposed to into the market or keeping it in the markets, we had to sell just like everyone else. And so a lot of these securities took a real hit. It had been, I think it's always been something that in this market where you don't have the support of the typical Wall Street dealers who trade agency mortgage-backed securities and those things, these legacy ones do offer more value, but they can be prone to times of lower trading volume, which is pretty much what we saw during that time, right? And so when everyone's rushing for the exit because of forced selling or because of redemptions and such, we were met with much less interested buyer base, right? Because most people were trying to handle their own redemptions themselves, and so it kind of came to a head in about the third weekend in March. We finally were able to meet this kind of final group of redemptions, right? And by that time, the fund was down about 45% in price, right? It had gone from being a $4.5 billion AUM fund to about $1.5 billion by that March 24th, I believe, was a Monday of last year. And, it was down 45% in price, right? And it was right around then that we kind of decided, like, it seems like the selling has subsided or is pretty much finished. We still like all the fundamentals backing these bonds. And so, on both a personal basis from the portfolio management team, we put in more money and we kind of, got on and folks like yourselves and anyone who stayed with the fund, from that point started to see it recover more fully. Right. I think going into that too, as we all wondered if the virus was going to be something that killed everybody, along with that, people were thinking that the financial system was about to collapse. Right. There were actually articles which said that mortgages would be worthless. Right. That the piece of paper that everyone had that, said that they owned a home or, determined who had the lien on the home, that those would be worthless, and that suddenly all homes and all the mortgage system, everything was going to collapse. And no one would know anything. No one would own any homes. There'd be no banking. It was really crazy in those times. And so you're kind of going from that and people wondering and that kind of uncertainty to about, 3 months later where people start to realize, okay, good. We're not all dying immediately, right? And certainly there were a lot of lives lost. I don't want to downplay any of that at all. But I think they also started to realize that, you actually can go outside, that you can breathe the air, that in fact, maybe the rate of infection and the rate that had to go into the hospital for more serious things was much lower than expected. All those things, right? And so as we saw that, we certainly started to see the market recover both in our markets. Low rates really helped the equity markets to come back and to help our markets come back. And then kind of again, as we move along through the year, people start saying, nothing really happened to the housing market. In fact, what we started to see more was that people were rushing to leave cities, right? whether it's one of those stories where, New York City became a ghost town because people started moving out to the suburbs, or San Francisco or LA. People wanted to get out of the big cities and then go buy another home or just trade their condo for a home. And so housing has been on a tear, right? It's up, the most recent reading was kind of 14% year over year, and the prior reading was 19% or something along those lines. And so a lot of that recovery has really helped bolster, the recovery in our securities. As I mentioned, we're up 80% since that low tick in the time of last year. Now, that's great. I'm glad we recovered. I'm glad that you all stayed with us. Would I have wanted to drag you through that with us? Of course not. And I certainly don't think that any of us would have wanted to go through that, and we wouldn't have wanted to go through it. It did allow us to buy more legacy securities cheaper in those early kind of recovery days of the pandemic. So that's good for the portfolio now. I think another big lesson that we learned, or just, if it's a lesson, is just so much an adaptation to these times, is that our liquidity laddering is probably a little bit more defined. I think that we have wanted to keep a little bit more cash on hand, and I don't mean just cash in the overnight sweep per se, but cash or cash-like vehicles. We are using some mortgage ETFs, which they basically kind of return as much as call it 1.5% or 2%, and so that's kind of almost like a higher yielding cash substitute, if you will, because we can get rid of that, or we can raise cash with it very quickly if we need to. We maintained and still have our pretty sizable line of credit, and we still have an allocation to CRT, which is kind of another. It's credit pieces of agency mortgage-backed securities, okay? But they're not government guaranteed, but they do trade more widely or across more dealers, and so we look at that as a more widely traded, for lack of better terms, a more liquid product. So between our allocation to CRT, a little bit higher cash, and some of these ETFs that I mentioned, as well as a line of credit, we can raise about 25% of the fund's AUM without selling a legacy security. Right, and so we think we're in a better overall liquidity position than we were going into this time, or not this time, but going into kind of pre-pandemic times when markets were really heady and there was lots of liquidity. And so we think we're better prepared for that now if we do see something like that happen again. I think also the fact that the Fed stepped in with different liquidity facilities and those things that I mentioned, Powell and his thoughts on his own role, or the Fed's role in these kind of things. I think that the collective investment community is more prepared to see the Fed do something like that again, so that we all kind of know that we don't have to just run for the exit, so to speak, as quickly. I think different circumstances and different events would dictate different things, right? That's a pretty obvious statement. But something like that again, or kind of seeing something like that again, I think that there are a lot of different mitigating factors in place, both for our fund as well as the broader markets, which would keep that from happening again. So, let's all, knock wood and keep hoping that we see this recovery, and still have a very cautious eye, and thus, for that reason, we're still kind of keeping those measures in place as we see the fund continue to recover and get back to where it had been, and hopefully exceed that as well.
Well, Brian, as we mentioned at the top of the call from our investment philosophy, we do take a long-term view, and so we share viewpoints with kind of the way that you and your team viewed that through that March spring period of last year. And so we're grateful for you guys, and grateful for what you do inside of our portfolios and for our clients. And I want to thank you again for the time being with us this morning.
Thank you. Thank you.
Absolutely. Well, now we'll transition as we could begin to conclude, kind of tie all this together with a view of our investment committee and outlook. And so I'll introduce Nathan Willis, our Director of Portfolio Strategy, as we begin to kind of tie all this together in terms of how we're reviewing the markets going into the fourth quarter. Nathan?
Good morning. Thanks, Cole, and thanks, Brian, for being on the call with us today. Cole, if you put the next slide forward for me. Thank you. let's just pull back a little bit to talk about how we build portfolios. So we have two pieces to our portfolio construction process. The first is the strategic, it's the roadmap. And you set this with your advisor, and it's designed to help you get to where you need to go, right? It's very long-term. This doesn't change very often. Secondary, we also have another piece of the portfolio called the tactical, or we call this the navigation. And this is what happens when you need to make a slight adjustment, not that you've gotten off track, but just to make sure you're on track. And so what we do is we update this process monthly, and we try to take an objective assessment of the health of the global markets. And what we're looking for is what we call behavioral alpha, or to quote Warren Buffett, we're trying to be greedy when everyone else is fearful, and be fearful when everyone else is greedy. And so every now and then we'll make tactical adjustments. In fact, one adjustment we made last month is that we made a slight increase in our holdings of the alpha-centric income opportunities fund. So that's one tangible thing that we've done recently. But when we put the two of these together, we get your overall portfolio. And the strategic and the tactical fit together. So what we're going to do now is talk about the navigation portion of that portfolio. So our navigator outlook consists of 4 areas. First, the technical, the sentiment, valuation, and the economy. For purposes of time today, I'm not going to go through technical or sentiment. I'm going to skip through those slides because we haven't made any change to those really. The technicals, I'll show you, are neutral in our mindset, and sentiment is positive as it has been for the last couple of quarters. We have a decent amount of bearishness in the market in individual investors, and we see that as being pretty healthy. That gives us expectation that we're going to have decent market returns going forward. What I want to spend a little bit more time going through is valuation, and I'm going to show a couple of different things this time. But first, what have we been saying about valuation for several quarters? We've been saying that the market is expensive, okay? And we still think that. So how can you resolve that? Or how does the market get cheap? What happens after we decide the market's expensive? Well, 2 things can happen. Either prices come down and the market gets cheaper, or earnings goes up. And what I'm going to show you now is that the latter has happened. So what we're looking at here is a chart from JP Morgan, and this brown line or green line in the middle is the S&P 500 price return. And so this is a year-to-date chart, and you see it pull back a little bit in September, but we're just under 15% in price return for the S&P 500 this year, which is really good. But if you look at the line above that, the gray line, earnings growth, and you can see it's listed there. Earnings growth is 26% for the year. So earnings have performed a lot better than the stock market. And the effect of that is this blue line at the bottom. This is indexed to 100, so you can see it's gone from 100 to 90. So valuations have gotten about 10% cheaper for the S&P 500. While we still think stocks are expensive, they're not cheap, it's actually really healthy that valuations have come down a little bit. So then I want to take a little bit of a deeper look at the valuations of the US market versus the non-US market, and the valuations of the large cap US stocks versus mid cap and small cap. You know, Cole talked about that we build very diversified portfolios. So we have slices of international stocks, both small and large, slices of emerging markets, and we have slices of large cap US and mid and small cap stocks. So let's look at the US versus the international markets, okay? What we're looking at here is a chart since 2002 of the price to earnings ratio of the US in red and the all country world ex-US in blue. And so what that means is everything that's not the United States. And so it's interesting to note here that after the financial crisis, as our economy grew stronger than the rest of the world, there became a bigger and bigger gap between the valuation of the US economy and the rest of the world, right? We got more and more expensive. And so you can see here during 2021, we've gotten cheaper. But if you notice, the international markets have gotten even more cheap. And so we feel very good about having a good bit of your portfolios, an appropriate slice in international markets. Let's shift to the US and show the comparison between large cap and mid and small cap stocks. So again, in this chart, the red line is large cap stocks And then the blue and green lines, which are pretty close to each other most of the time, the blue is mid caps and the green is small caps. So it's interesting to note, looking back to the tech bubble was all concentrated in the large cap technology stocks, and the large cap portfolios were way more expensive than small and mid cap stocks. Whereas today, that is not as much of a premium. Another thing to note, this year, stocks have pulled back, or the earnings have pulled back, PE rather, have pulled back for the large cap stocks, but it's pulled back even more for small and mid cap stocks. And if you look at this chart, mid cap and small cap stocks are much closer to their long-term average, which gives us some good confidence. So we again have a decent amount of the portfolio in mid cap stocks in particular, and we feel very good about that. So let's transition to the economy. Now, Brian talked about it, so it won't surprise anyone, but if I polled you, think for a second, what is one word you're thinking about for the economy? What would that word be? I imagine for a lot of you, it's inflation, and Brian talked about it. Now, I have to tell you, Brian and I didn't plan this together, but Brian and I chose the same thing to talk about with inflation. So this is actually a picture in December 2019 on the left of the ports of LA and ports of Long Beach. And each little yellow dot is a boat waiting to get its stuff off to go onto the trucks to get to the rest of the country. And in September 2021, in my counting, there was 80 some. I think Brian said the record had been 90, and this year it's over 100. So I'm not going to spend any more time talking about inflation. I think Brian did a really good job doing that. But what I'm going to do is talk about forces that might hold inflation down over the long term. I think it's important for us to understand how things might be different going forward than they've been in the past. Okay, so we're going to talk about three things. The first of them is China. I know a lot of people are thinking about China and worried about China, but this chart is about the unwinding of China's real estate bubble. Okay, so what we're looking at is these Chinese ghost cities that the press has written about. In fact, the one on the left there is from a video of a guy. He is a CNN reporter walking down this street at 8:30 a.m. on a Tuesday or Wednesday. So this is rush hour, and you can see there's no one there. And this is one of the ghost cities. Now, the thing I find most interesting about this picture is this video was shot in 2016, over 5 years ago. So the unwinding of China's real estate bubble, or the existence of a bubble, isn't a new thing. We all knew about it. But what is new is what the Chinese government is doing about it. And so last year, about this time, September and October of last year, they introduced a policy to try to curb speculation in the real estate market. And so what that has done is that has caused developers to have to borrow a little bit less. Now, Evergrande is two things in China. Number one, they were the largest developer. Number two, they were the most aggressive in terms of speculating on land. So what they would do is they would buy land and they would sit on it a while before they built, okay? And so they would generally benefit from prices going up, but that's kind of gone the other way as the Chinese government has put in measures to curb speculation. And so what's happening is the Chinese are trying to manage a reduction in this bubble, okay? Now, let's talk about what won't happen, I think, and what will happen, I think. What won't happen is that this will not affect the rest of the world's financial markets. And the reason is the Chinese financial markets are not nearly as integrated with the rest of the world. There are not a lot of non-Chinese banks that are lending into China. Okay, so we don't think there's going to be a big contagion from the financial markets. But what will happen, we need to think about when we look at that picture. So what is there in all those buildings? There's a ton of cement, there's a ton of rebar, a ton of metal, okay? So for the last 10 years, China has been the dominant consumer of raw materials. That's going to taper, if not go away. And that is in general going to keep inflation down. So it's a big force over the next 10 years that's going to keep inflation down. Next one I'm going to talk about is a little bit more fun. So my dad was an early adopter with computers. And so we bought an Apple II in, I think it was maybe 1979. This price list is from 1977. And I picked the top of the line one where you could get 48K of memory. And that costs $2,600. Now, if you go to Google and ask it about inflation adjusting that, that's about $13,000 in today's prices. relative to this MacBook Air I can buy for $100 or for $1,000 on the Apple's website. Now, I did something else that was fun. I took this slide we're looking at and I saved it as a PDF file, okay? So the RAM, the memory in that computer is 48K. This one slide we're looking at is about 120K. So it couldn't even fit on this computer. Now, we're not, but I could have run this whole conference call from my iPhone walking through the airport, and you probably wouldn't have known. So technology has improved drastically. But what I thought I would do is also give you one real tangible example. When you're shopping at the hardware store, the clothing store, the electronics store, how many times do you pull out your phone, pull up your Amazon app and check the prices, right? Probably most of the time you're out shopping. And that tends to be deflationary, so that's going to hold prices down. The last thing I'm going to talk about, we may not spend as much time on. This is called a population pyramid, and hopefully the animation comes through. But what it's showing you, it starts in 1980 and goes through projections of population in 2050. And here's what it's showing you. It's showing you on the right the percentage of population at each age, and on the right is men, and on the left it's the percentage of women population. And so it's called a population pyramid because in general, there are more younger people, right? One of the things you can see here is the big chunk of baby boomers moving up through this pyramid as it keeps going through. And in order to make the point I want to make, I'm going to stop it at the projections for next year. So if you look here, the baby boomers are just getting ready to start retiring, okay? Then you've got one other little population bubble there with the millennials, and they on average are around 30 years. So they're in the workforce now. But what happens after this? Below this, our pyramid is not very pyramid-y anymore. It shrinks. So what's going to happen is, as we move on 10 years from now, the labor force is going to start shrinking because baby boomers are retiring and not enough people are replacing them. Okay, so why is that important? I'm going to go to one more slide, which is a bit technical, but it will illustrate this. This chart shows on the horizontal axis working age population growth, okay? And then on the vertical axis, it shows economic growth. You can see that as working age population grows, economy tends to grow well. And this was done in the 2000s, and it was used to illustrate Japan. Japan had negative population growth and their economy shrunk. So this is going to hold down our economic growth. And also it's worth noting, we looked at the US population chart. Most of the developed world economies have a similar population chart, population pyramid. So I've talked about three things that are going to hold inflation down. Well, why? The reason is the last time we had inflation was the 70s. And so a lot of people are saying, we're going to go back to the 70s, we're going to have high inflation. None of these three dynamics existed in the 70s. In the 70s, we were at the very beginning of a credit cycle where credit was growing drastically. In the 70s, we didn't have technological innovation that really started in the 80s, despite the fact that I showed you an Apple II in 1977. Most of the boom in technology started in the 80s. And then the economy, or excuse me, the population was growing very fast in the 70s. So we're not likely to have the same kind of inflationary pressures that we had in the 70s. So even if this inflation we're seeing now is not transitory, we're probably not likely to see the kind of inflation we had back in the 70s. So I think it's worth having that perspective. We haven't talked a ton about current things in the economy, but we're calling the economy neutral, okay? So where does that lead us in our asset allocation? Let's look at a moderate portfolio. And as you can see, a moderate portfolio, the strategic allocation or the long-term allocation is 60% stocks, 40% bonds. Right now, in our judgment, it makes sense to be neutral to that. So we are 60% stocks and 40% bonds. And it's worth noting there, the second line from the bottom, we have 10% of your portfolio in a moderate portfolio in the alpha-centric income opportunities fund. That's how we're implementing our high yield allocation. So then let's talk briefly about performance. And again, let's look at the moderate allocation, the third one down. As you can see, we had a little bit of a pullback in September as the S&P pulled back, but the quarter to date, the third quarter, the year to date and 1 year performance is slightly ahead now. And as you can see in all of our portfolios, the long-term performance is really good. If you've got specific questions about your performance, I would encourage you to talk to your advisor, and we are happy to help in any way we can. With that being said, I'd like to turn it back to Cole to see if we have any questions, and thank everyone for being on the call.
Thank you, Nathan. I appreciate those comments. In the one thing that Nathan didn't mention on the performance side that again harkens back to the investment philosophy is everything that we do is values-based. So we're looking for managers in each asset class that we just showed that are investing in companies, first avoiding companies that we believe are causing harm, but also investing in companies or in asset classes like housing that are providing value and flourishing to the world, to society. So when we compare against our benchmarks, those indexes do not account for that. And so we're pleased with the fact that we can still outperform in a values-based way. So Nathan, if you'll advance to the last slide. As we wrap up, in the interest of time, we'll need to conclude here. But if you'd like to learn more about OneAscent, maybe this is your first call, we'd love for you to speak to an advisor or to reach out to us directly at info@oneascent.com. We have lots of resources that we'd love to share and make available. You can find those on our websites, or we can share those directly. Things like our allocation dashboard, more of what you just heard in printed form, fact sheets on each of the portfolios that we manage, or our investment commentary. I encourage you to go to our website and subscribe to that. We put that out weekly. You can follow us on all of the social media channels if you like, or the old-fashioned email or phone. We'd love to speak with you. Thank you again for investing a portion of your day with us today. We hope that it was valuable and meaningful, and we appreciate your time. With that, we'll conclude our call, and we'll look forward to talking to you again in January. Thank you, and have a great rest of your day.